just a little bit. Yeah. So, tonight we're going to talk a little more, or continue to talk about all the things that we can do because we have been given the hope of the resurrection. Tonight, Evan Tidball is here with us as financial advisor with Edward Jones, and I've had the chance to get to know Evan a little bit. I believe kind of the first time we rubbed shoulders was out at the Community Light out at Whitstrand. And I got to know about your family a little bit, and I'm glad that you and your family are part of this community. And I'm glad that you're here tonight. At the end of Evan's presentation, we'll have time for Q&A, okay? So be prepared for that. We're also recording it so that folks can view it later. I wanted to start with some words from Scripture. As I thought about Evan's presentation tonight, I was reminded of a passage back in Genesis. Joseph is in Egypt, and Joseph's gone through some tough times. And he's, by God's grace and God's sovereignty, he's risen up in Egypt. And Pharaoh has a couple of dreams. He dreams about 7 fat cows and 7 skinny cows and 7 full heads of grain, and then 7 ones that are kind of stricken. And so Pharaoh asks him, what does this mean? And here's what he says. It is just as I said to Pharaoh. God has shown Pharaoh what he is about to do. 7 years of great abundance are coming throughout the land of Egypt, but 7 years of famine will follow them. He's going to tell him about how to plan for the future, is what Joseph's going to do. Then all the abundance in the land will be forgotten, and the famine will ravage the land. The abundance in the land will not be remembered, because the famine that follows it will be so severe. The reason the dream was given to Pharaoh in 2 forms is that the matter has been firmly decided by God, and God will do it soon. And now let Pharaoh look for a discerning and wise man and put him in charge of the land. Let Pharaoh appoint commissioners over the land to take 1/5 of the harvest of Egypt during the 7 years of abundance. And what Joseph goes through and says, here's how you plan for the future. Here's how you take the resources that God has given to you and plan for the future. And then in the New Testament, I believe, and we talked about this a couple Sundays ago, Jesus takes that same story. I think he had that in mind, or he tells one that's really similar. It's in a parable. And he says, the ground of a certain rich man produced a good crop. Same kind of idea. He thought to himself, what shall I do? I have no place to store my crops. Then he said, this is what I'll do. I'll tear down my barns and build bigger ones, and I'll store all my grain and my goods. And I'll say to myself, you have plenty of good things laid up for many years. Take life easy. Eat, drink, and be merry. But God said to him, you fool, this very night your life will be demanded of you. Then what will you get? What you have prepared for yourself. This is how it will be with anyone who stores up things for himself, but is not rich towards God. Jesus is not against the whole idea of planning for the future, like took place with Joseph. But Jesus says it's not just about the question of how you do it. He turns it around to say, why are you doing it? And what will you do with it? That's the important question. Now, Evan will tell you about how, and he's going to do a really good job. He's just like Joseph. But there's a question that each of us has to ask. Why? Why do I save up for the future? And how will I be rich towards God's purposes? What are God's purposes in my family? What are God's purposes in my community? Or in my church family? Or in my circle of influence? Evan might have some ideas about that, but you're the only one that can really answer that part of the question. So why don't we start with prayer, and Evan will tell us a little bit about the how stuff. So you pray with me, please. Lord God, we thank you for all that you provide. We thank you that you are generous to us and that you have require us or ask us to use wisdom with what you've given to us. I thank you for Evan. I thank you that you've given him insight into things to do with the resources that you've given to us. Lord, I pray that you will fill him with the Holy Spirit. And Spirit of the living God, use him tonight. And help us to not only ask the questions of how, but what? What are we to do with those resources that you've given to us, resources that we store up for the future? We realize that our time in this world is limited. And there may be a day, any time, where you say, enough, and we get to spend eternity with you. In the meantime, you have asked us to be wise with what you've given to us. Lead us tonight. We pray all these things in your name, Jesus. Amen. All right. Thanks.
Well, thank you very much for having me. Thank you for the opportunity to come in and talk and chat, share a few insights. So as Paul mentioned, my name is Evan Tidball. I've been in Prosser now here for 5 years, going on 6, and it's been a wonderful, wonderful community. So just a little bit of a background or history about me. I grew up over in Paulsville on the peninsula of Washington, and I've got an older brother and a younger sister, and we all graduated from North Kitsap High School over there. I ended up signing a letter of intent to come play football for Central Washington University. So that was my ticket to the east side of the mountains, and what I did to find my way here and fall in love with the place, really. Ellensburg has a special place in my heart. It's where I got to get out of the house and grow up a little bit, play a little football, have some fun. But although I grew up in a Christian household and had that influence and that that perspective growing up, I really don't think it was until my sophomore year in college and kind of through my football career that I was able to really commit my life to Christ. And so I kind of share that conviction with you, just to know where my heart's at when I think about money, when I think about how I serve my clients, things like that. And it is a neat opportunity we have. It's a short amount of time here on earth that we have, but an important one. And I think that God does call us to do things. He calls us to steward our money well. And so I'm here to help maybe share some insight on and expand on what Paul was talking about, how we can do that, and how to prepare for the future. Paul mentioned that the topic of the series was kind of end of life and how do we prepare and do that well. So I hope to keep my conversation very lively. It's going to be kind of an interesting topic. Talking about end of life is it's not the most exciting, but there's a lot of great things from my perspective that we can all be doing to make sure that we're preparing for that well. So I'm looking forward to that. Another reason I like Ellensburg is that that's where my wife and I met. So we met actually after I had finished my football or my college career, and so we had brushed elbows quite a bit, but I never really did get to spend much time together. So I finally worked up the nerve to ask her out, and on her first date, she told me she had about 2 weeks left in Ellensburg before she was going to her student teaching in Wenatchee. So I thought, well, I've got 2 weeks to get on her radar screen and for our paths separate. And so anyways, she bared with me while I was still finishing up work. I worked for Anderson, Hay & Grain in Ellensburg after I graduated for a few years. And I was actually working in their recruiting or in their HR department doing recruiting and staffing for them. And so I guess I share this story to talk a little bit about how I ended up at Edward Jones and why I do what I do. I've got a lot of family that's involved with Edward Jones, actually. So my uncle, my dad, my brother, and 2 cousins are all Edward Jones financial advisors. So I had always known that it was something that I would probably do and probably enjoy, but I didn't want to do it just because everybody in my family has done it. And so that was my stint in HR, and it was just an opportunity that presented itself as I finished up schooling there. And so anyways, Mindy, bless her heart, bear with me as I finished up time in Ellensburg while she was in Wenatchee. I quit my job after I had gotten hired with Edward Jones, and I moved back home with my parents for 3 months while I locked myself in a closet and did my studying for my licensing for 3 months. I thought it would be nice to be able to pick my dad's brain if I ever needed anything while I was there. And then from there, once I got my licensing done, I moved to St. Louis, Missouri. So I'm going halfway across the country to do a drink from the fire hose training for 6 months, and it was a wonderful opportunity. And it really was designed for folks like myself that are in that life stage that we can uproot for 6 months and go soak that in. And so yeah, it was a great experience. And at the time, I was still trying to decide where exactly was I going to plan on and sticking down roots, and where am I going to start my practice. In that time frame, I was contacted saying, "Hey, Evan, we know you've been interested in Eastern Washington. There's a gentleman in Prosser who's retiring. Would you be interested in moving there and taking over his branch?" So I flew out on my own dime, spent a weekend here, and just explored the town as best I could by myself, and said, "Let's take a leap of faith and go for it." So here we are. It's been a wonderful opportunity. Mindy, after her and I got married, she moved in with me, and now we got 2 kiddos, and she taught at the middle school for a few years, and now she's just coaching girls soccer at the high school. But she does the important work at home, and we have a lot of fun with our kids. Mason, our son, is 2, so he turned 2 in October. He's a handful, all boy, very energetic, getting his words down, but just a lot of fun to be around. And then his younger sister, Isla, is our daughter that was born in June of last year, so she's just about 6 months, or a little over 6 months now. So yeah, we're just fortunate to have them, and Prosser's been a wonderful town to raise a family, and it's just been a great experience. So a little bit about Edward Jones. So just kind of a brief background. And a fun fact for this year, so we actually started in 1922, so this year's our centennial celebration. We're excited about that. We started our first branch office in 1957, and today I think we have over 14,000 branch offices and over 18,000 financial advisors. We're a little over $1.7 trillion in assets under care as a firm nationwide, and it's just been really neat to kind of obviously I grew up around it, knowing my dad he started his career in the home office, so we actually were born in the Midwest, Greenville, Illinois. And so anyways, he started there and worked our way out west when he took over his own branch office. But yeah, it's a wonderful firm, great place to work. In fact, we've been pretty regularly listed as one of the top 100 places to work for, and we've got some other Forbes accolades, which is nice. But one thing I really enjoy about it, and one thing I think that's a little bit different than other firms, is that we are employee owned. So we are still a partnership, even despite the size, where Ted Jones, the son of Edward Jones, who started it, he had the opportunity when he retired to sell the business, but decided, you know what, instead I think I'd like to give this as a partnership. I think owners think differently, and we don't want to have shareholders to contend with as we're considering our clients' best interests. So he gave the firm over to the employees as a partnership, and that's how it's operated ever since. And so it's a neat structure, and it's just a neat thing that we're proud of, and we hold that closely to us, and it's kind of part of our culture. So it is a neat deal. So tonight, what I was hoping to cover, again, we're kind of talking about end of life, what's the best things to do, best ways to organize, what are some strategies we can take. So the 3 things I wanted to cover were, one, organizing and simplifying is kind of my first topic I wanted to cover. So we'll cover a few details there. The second is strategies to take, basically, strategies that you can employ now, between now and then, when that time may come that you pass. And then lastly, we'll cover long-term care insurance and just chat a little bit, high level, what are some of the benefits, what are some of the reasons we may consider it, and what options are available today that maybe weren't available before, and just consider some of those details. Yeah, and I understand we'll have time for Q&A at the end. I really do welcome questions. I enjoy the back and forth. I was going to ask Paul, is that something we can do to have more of a dialogue? But yeah, if there's any questions you have, let's chat, and I'd love to have that at the end. So organizing and simplifying was the first thought that came to mind as I consider for clients, what are the best things to do to kind of plan for the future and plan for when we may no longer be here. The first thing to consider is making sure that beneficiaries are established on all of your accounts, and also make sure that they're up to date. So one thing that's unique about establishing a beneficiary for account versus just having your will, be the thing that dictates where assets are distributed to, is that the beneficiaries that are established on an account, they actually supersede what your will says. So we've heard a couple of war stories where somebody updates their will, but they had not updated their beneficiaries on their account, and maybe it was a situation as dramatic as somebody went through a divorce and remarried and just overlooked the previous spouse being listed as the beneficiary on the retirement account. Well, it doesn't matter what the new will says, the beneficiary is listed on the account, and that's legal. So just something that I think is really, really important is making sure that beneficiaries are established, but also up to date. The other reason that beneficiaries are important, even maybe doing transfer on death beneficiaries, for non-qualified accounts, this could be a bank account, could be a joint account, at a brokerage firm, or a bank account, any account that is not necessarily an IRA or a 401k. Having a transfer on death beneficiary allows your assets to skip the estate and probate process. So if there's no beneficiaries established, then the money does go into the estate, and it's up to the will and the estate process to divvy out the assets. Some people think that having things listed on a napkin in the safe is sufficient enough to call it a will, and it may be. The judge may consider that, but at the end of the day, it's up to the judge to decide how to distribute the assets. So yes, you do have some say, but if you really want to make sure that your assets are going where you fully intended them, having beneficiaries and transfer on death beneficiaries to listed for the accounts. So yeah, I just think that's all important. Again, having a will is part of that process, but having those beneficiaries does supersede what the will says. So best case scenario, beneficiaries match up with what your will states you would prefer and like to have. That keeps it real simple and clear for everybody who's processing after you're gone. But again, beneficiaries supersede that. Another thing you can consider when you are talking about consolidating organizing, but consolidating assets is a good strategy to consider as well. So when you're organizing, simplifying, getting ready for end of life, one thing that I think it's worthwhile for everybody to think through and consider is, where are all of my assets at, and how will the person that is processing my estate do this? How long is it going to take them? How much effort is it going to require? How many 1-800 numbers may they have to call? How many death certificates are they going to have to send out? I think that's really important to consider. You'd be surprised with how many people you meet with, I guess when you're on my side of the table, that have multiple bank accounts at different institutions. Maybe they have CDs at different credit unions because at a certain time they were offering a great rate, and they open that account and the money is still there. Maybe they have a 401k or a retirement account with their employer, that money is still held in that account there with the employer. And then maybe even in addition to that, there's IRA accounts at a brokerage or something like that. So if you start to list all of your accounts and all of your assets, and you consider where they are all at, what would that actually look like for somebody to go through and say, okay, this person has passed away and the money needs to be distributed, what's their work going to entail? So I think it can be a huge benefit and quite a service that you can do to the person that's processing your estate to consolidate accounts. So if you have multiple accounts that are tax deferred, like an old 401k or an old work retirement account, as well as maybe an IRA, any tax deferred asset you have, that can all be combined into one account. And so that would, if you've got one financial professional that you work with that you enjoy and trust, consolidating your account with them to make sure that, now it's just one person that the person that's processing your estate would have to deal with. They have to contact, that really simplifies things a lot. The other thing is that if you consider, the process, when someone passes away and there's an account that's kind of out in la la land that we need to get a hold of and help process, you have to get in contact with them via a 1-800 number. The conversation is never very, never very warm or great, but it's, okay, well, here's the process. Send us the death certificate. Once we get that, we'll process what we need to and send you a packet. Fill out the packet, send it back to us. It's all done via snail mail, and it might take quite some time in order to, actually get your hands on the assets and be able to move it to where it needs to go. Again, having beneficiaries helps out with that, but also if that money is, if it is eligible and could have been held more closely with, the financial professional maybe that you choose to work with, that process becomes a lot easier. It's a 509 number that they get to call, or maybe not 509, but it's a local number that they knew that they had a trusted relationship with the person they were working with, and if that account was transferred in from all these different places to one, it's just one conversation they have to have, with somebody that they knew you trusted, versus having 6 different conversations with all these different financial institutions. So I think that's another great thing to consider. Another side benefit of that is that, between now and then, there could be some opportunities for you to have that money invested appropriately and more according to a specific goal that you have on that account. So if it's an old CD account that, doesn't happen to be paying much interest anymore because rates are low, you've always had that account there because it was just where it's always been. It might be time to consider it for multiple reasons. Should I have this money allocated a little more, beneficial for me, but also too, is it helping my estate? Is it helping me organize and simplify for the next steps and for the next generation? So, I just, I really like to stress that. This next one, might be kind of silly and very practical though still, but, purge around the house. Obviously taking care of your assets is important too, but I've helped friends and clients and, children of clients to help just getting things cleaned out of houses. And it's, it's time consuming sometimes, and sometimes there's a lot of shrugged shoulders going, why are they holding on to this, and if there's things that you really desired seeing passed on to, the next generation, give it to them now or give it to them soon, as opposed to waiting and letting them decide whether or not it was important for them to have. It just helps, again, with the process of getting everything organized and, making things easy for the next generation to take over. So the next thing is, deciding whether or not a trust is necessary. So a will, again, a will is a written document that allows you to decide and tell, the estate probate process where you would like your assets to be transferred, and also designate a probate, the person that will be, processing your estate. And so that is important, but the next level, it doesn't give you much control beyond that. And even the words that are written down on a will are not necessarily, they're not exactly what needs to happen by the judge. So then the next step is establishing a trust. Again, working with an estate planning attorney, who I think you guys are hearing from an estate planning attorney next week. Yeah, so this would be, I'm sure he'll be able to elaborate more on that. But, having a trust established is something that allows you to control your assets from the grave, essentially. So if there is a situation in your family where you've got multiple kids that you want to make sure that your money is passed on to, one happens to be a spendthrift, and you desire to give them an equal share of the assets, but you just fear that that money is going to be spent within the first 6 months they have it, having a trust is something that allows you to control how and when and how much that that person gets to spend at a certain time. and you can have maybe one of the other children or someone else in the family who's trusted be the executor or the the trustee on that account that can manage it and control that. But it just allows you to have some say on how the money is used, or maybe when it's used, or how much of it is used. The other benefit is if there happens to be multiple states involved. So if you have a piece of land in Idaho and maybe a retirement or a vacation spot that you enjoy down in Arizona, as well as your main homestead here and accounts here, if you pass away and all of these assets are going to need to be distributed, you will have to go through probate for each one of those, each of those states. Having a trust established allows the trust to be the owner, and it avoids probate in each one of those states, and it allows you to process things a little bit easier. It allows your beneficiaries, your trustees to process that a little easier. So that's another thing to consider, and why maybe a trust would be a good thing to consider. Yeah, and so again, it's just, those are really good questions. When it comes to trust especially, having an attorney involved is a good thing to consider. If it means anything, the attorneys, they're the ones that are going to actually write up the document and legally bind it. That way it's structured the way you need it to. Someone like myself would get involved only when and after that trust is established. So you'd go to the attorney to say, hey, I need this money to go a certain place no matter what happens to me. And they would write that document up, and if there's any assets that you want to place in that trust, like mutual funds or stocks or bonds, and you want to have that trust account somewhere, that would be someone like myself who can help manage the trust account and according to the way that the attorney had written it up. So hopefully that helps just to kind of paint the picture of how those relationships work and who you would go to. So again, just organizing and simplifying, I'll recap, making sure that your beneficiaries are established, also that they're up to date. Consolidate assets. I think that makes a lot of sense. I've met with folks in my office who brought in a big binder full of documents and said, these are my assets and I've got them all listed here, but even literally they're individual held securities at the fund company, and so the person that was processing that would have had to call. I mean, I'm not kidding, it must have been 15 or 20 people. They'd have to send out that many copies of death certificates, and for this particular person, it was their goal to just make sure it was easy, that upon their passing, they could just pass it on to their kids easily. And so having a brokerage account where you can consolidate assets to, whether it's an IRA, their IRA assets, old retirement account assets, or if it's individually held securities or joint account, CD money, etc. Those can be consolidated to do it. Yeah, purge around the house. It's just, if there's things that you want to give away or you want to see your kids have, do it now while you can see them, and you might find out they never wanted it, and it saves a little bit of hassle later. So, and then the wills and the trusts. So the next strategy, or the next thing I want to talk about, is strategies that you can take now, with your assets in order to maximize your maximize your funds for yourself, but also for the beneficiaries. And none of these are going to be very specific to any certain scenario, but they're just strategies again overall that might be a good thing to consider for anybody, I think. So the first one I want to talk about is called a Roth IRA conversion. And just for anybody that doesn't know, traditional IRAs or traditional 401ks, those are accounts where the assets are put into the account on a tax-deferred basis. So if you were contributing to a retirement account and maybe you happen to have a traditional 401k, or maybe you work for the school system and it was a traditional 403b account, or a church and it was a traditional 403b, then the money goes in there and your salary gets deducted on a dollar for dollar basis, the amount of money that you put into this account. And the benefit to you is that you get a deduction in the year that you make those contributions, the money grows, and you don't have to pay taxes on that money until you start pulling it out and actually using it. You will at some point be required to do a distribution called a required minimum distribution. That age is at age 72 now. It used to be 70 and a half. And on the other side of that, the Roth IRA, that's an account that, a type of an account that was, available relatively recently compared to the traditional, 401k and IRA accounts. So Roth IRAs, the money you put in there has already been taxed. You don't get a deduction on your current income tax in order to make that contribution. However, the benefit to you is that as it grows and when you take it out later, you don't owe any taxes on the growth in this investment account. So if you turn $10 into $10 million in a Roth IRA, you don't owe anybody any taxes on that money in that account. So it is a nice benefit. The Roth IRA conversion, that idea is that you might have accounts that are traditional or tax deferred, and you might be in a position where it would make a lot of sense to consider just ripping the Band-Aid off on a portion of those assets and putting that money into a Roth IRA now, and they call that process a conversion. And so it shows up on your taxes as earned income. You'll pay taxes, you have to write a check for that tax bill when it comes in April. But the idea is it's reducing your tax deferred account value. So it's going to end up lowering your required minimum distribution down the road. It's going to reduce the tax deferred account value that you may be passing on to your beneficiaries. And now all that money is growing in a Roth account where it's tax free. So if you are nearing retirement or early in your retirement, let's say maybe you're 65 years old, some people think, well, I just don't want to pay the taxes now, I'll pay it later. It's all good and well, but if you really analyze and see where your tax brackets are and how much wiggle room you have inside of that bracket before you would actually, cross over and maybe increase into the next tax bracket, it might be worthwhile to say, there's a couple dollars here that I could convert, and now it's all growing tax-free. And I'm not paying any more taxes on it now than I would down the road. Or if you're like me and you look around and you see, just all the things that are going on in the United States that, a lot more government spending and needs for improvements here and there, you'll probably come to the conclusion that, taxes are more than likely going to go up in my lifetime, certainly, but, it's over the years, taxes, I think, will most certainly go up and we'll need to, and it'll be necessary. So the tax rate that you're in now, in my opinion, it may be lower now than it will be 10 or 15 or 20, 30 years from now. And so just, again, converting your traditional dollars to Roth dollars now, paying the taxes at the tax rate you have now, may be beneficial. Some people are in a really low income tax bracket now, but when those required minimum distributions come around, you'll get bumped up. So it makes sense to get that money converted now while you're in that lower bracket. Other people, they'll never change income tax brackets. So I think that, again, it's another reason to consider it, is that it doesn't matter what you're paying in tax, or the taxes you will pay won't change between now and 20 years from now. You might as well just start converting it and pay those taxes now and at least get the years of tax-free growth later. If the opportunity presents itself, that's a good strategy to employ during a market downturn. So there are some good things that can come from market volatility and downturns in the market. If you convert securities that are down in value because the market overall happens to be down, you're converting the same dollar value. You pay taxes on the dollars, not the number of shares. But if we have Microsoft stock today and it's worth $315 a share, but it happens to drop to $200 a share because of a major downturn, you convert those dollars at that price, and now it's recovering and growing again for you in the after-tax account or tax-free account. So, certainly that's something you want to talk to a CPA about too. When I'm working with my clients and we're having that conversation, I always try to call the CPA just to get their permission, get their second opinion, because they'll have the best perspective for you on where you're actually at in the income tax bracket and how many dollars you may actually be able to convert in that year. Probably don't want to do it all at once, because again, if you've got a large traditional tax deferred account that you're converting all at once, that's going to be a huge tax bill, puts you in a way higher tax bracket, you name it. So something to consider that you just kind of do a little bit over the years until the time comes that you pass. Another benefit, I guess, of the Roth IRA, again, is that all that money goes tax-free to your beneficiaries. Traditional assets, if you do have a traditional IRA or 401k account or something similar, you're going to have to pay taxes on that money as you pull it out. If you pass it on to your children, then that money is, again, it's going to be required of them to pay taxes on it. And they may still be working, potentially at their highest earning years in their career, so they may already be in a higher tax bracket, but then if they're having to take extra money out of that account, that's going to be, more money added to their income, which could be, if you think about a generational wealth standpoint, you could pay cheaper taxes now for them versus them paying higher taxes later. So that's something else that you can do. It's benefit for everybody. So yeah, another strategy to consider, especially if you are at that age 72 where you have required minimum distributions that are required, or if you're starting to think ahead and plan for those, there's something called a qualified charitable distribution. And I think everybody should consider this, especially, our fellow congregates. But when you are required to take money out of an IRA or a 401k at the age of 72, there's an opportunity called a qualified charitable distribution where you can give money directly out of that account to the church or the charity or service organization or whoever it may be that you want to give this money to. If that check is written from your account, which your financial institution should be able to do for you, then the amount that you give out of that account will help satisfy, all or a portion of your required minimum distribution. However, instead of you having to pay income tax on that money, because it went right to a charity or a church, you don't have to pay that income tax. So just as an example, if you've got a required minimum distribution of $15,000 and you don't necessarily need to spend that money yourself and you are already giving money to your church, consider just giving that money to the church, directly from your IRA account, because now you don't have to pay income taxes on it. It could potentially allow you to give more than you normally would, and you're satisfying the amount that needs to come out per IRS rules. So it's a great strategy, and again, I think it can maybe even increase your charitable giving potential because there's money that you're not having to send to the IRS that you may want to consider, giving to someone else. And I've worked with clients on that too. I should just point out that, if somebody is giving regularly, instead of writing that check every week and having money come out of IRAs that help supplement income everywhere throughout the year, but they're writing that check, if you've got a dollar value that you want to give based on your tithing percentage you prefer, or the dollar amount that you're convicted to give, then just, do it once a year or do it twice a year and have that come from that account. Another thing to consider is gifting stocks. So another strategy very similar is, if you have appreciated stock, maybe you've got that crazy Uncle Ned that told you about some small startup called Amazon.com, and it happens to now be worth a lot per share, and you're seeing a huge gain that you don't necessarily want to have to pay that much in taxes on. And let's just say this money happens to be a non-qualified account, so just a stock held in a brokerage account. One strategy you can employ is instead of giving cash to the church or the charity, as you may already be doing, consider gifting the actual stock itself. Nonprofits, they do not have to pay capital gains on shares of stock or mutual funds that they sell. So if you're holding on to a stock that has a gain that you don't necessarily need or want to pay that gain on, give that stock away instead of writing that check and giving the check away. That's just another way that you can help benefit whoever it is you're giving. You might be able to give more because you're thinking, I'm never going to use the stock for anything else. I'd rather just hold it until I pass away and let somebody else take care of it. But you can give more by giving away your securities. That's another strategy. If you do plan on selling that particular stock at some point for yourself, one extra layer for that particular strategy is if you have, let's just say the number happens to be $5,000 that you want to give to whomever it is you're giving to. You can give, and let's just say you have a written check for $5,000 and you've got your $5,000 worth of securities in the other hand. You give the $5,000 to the worth of securities to the nonprofit organization, and then you want to, in turn, lower the taxable gain that you have that you need to report for yourself. You know, if you, again, compare giving the $5,000 check versus the $5,000 securities, give the securities and then just go purchase $5,000 more of that particular stock or security that you're buying or giving. So, you know, and one strategy there is, or the thought is, your position in that particular company or that investment never changed. You were able to give the money that you wanted to give in the check, and now instead of giving the check that you've already paid taxes on, you're giving the security that you've seen a nice gain on, and then depositing, you know, that check or buying the more securities. It increases your cost basis, or increases what the IRS thinks you've paid for that particular stock. And so now, when you do go to sell that down the road, the IRS is going to see that you've paid a little bit more than maybe you originally had, and it's lowering the taxes that you're responsible for. So that's just kind of another little trick that you can employ. So another thing to consider is, you know, there are, you know, although it's high, the federal estate taxes, I think over $11 million you have to worry about. So more often than not, most people don't have to worry about paying federal taxes when it comes to estate processing. However, in Washington state, that limit is $2,193,000. So if you add up all of your assets, which would include your, you know, 401k accounts, IRA accounts, house value, you name it, if you happen to fall, you know, in that category where your total assets are over that, you know, there will be a state level estate tax that's assessed. And so, you know, if anybody's approaching that, I always just want to, you know, encourage them to consider maybe giving a little bit more money away, whether that be to children or grandchildren, you know, the church or their service organization they like, or the hospital or whoever. But also, you know, maybe you want to consider doing a family vacation or something like that, where you're paying for everybody in your family to go on a vacation. Because, you know, at the end of the day, if you're just watching your account values grow and your real estate values are growing, and you know that by the time you pass away, you're going to have, you know, above that threshold in value that could be processed, then you might as well consider that either the state is going to get a portion of that, or you can give it away, and it might be a little more fun and enjoyable, and, you know, that, you know, your family gets the benefit versus the state doing whatever they may do with it. So I like to encourage folks that way too. Just you know, either the state's going to get it in tax money, or you're going to spend it and do something fun with it that you can see and witness. So I'd encourage that. Yeah, and then so the last topic of conversation is, and I should point out too, you know, after this next topic, I did have a printout that maybe you grabbed on the way in, and that's basically kind of a mock client report that I've done up that talks about basically a checklist that you can go through. So I'll go over that lastly. I don't think I mentioned that early on, but yeah, this you know, this third topic is long-term care insurance. And just considering who might it be a benefit for, why would you want to consider it, what options are available, so we'll go over all of that. So I should point out, you know, Medicare and Medicaid, you know, are, you know, I guess there's a difference there that not everybody understands completely. So, you know, Medicare is more just for the insurance side of things. So that covers, you know, medical visits, surgeries, prescriptions, etc. Just normal health care, you know, things that may come up. That's what Medicare is for. There are no benefits that come from Medicare for the need for long-term care assistance or nursing home care, or somebody to come visit you in your home and help do medicine and laundry and cooking and things like that. Medicaid, on the other side, Medicaid is a state program that does help cover costs for long-term care. However, in order to qualify for that, it requires, you know, pretty much that you liquidate everything you own, and it's tough to see when it has to happen. Sometimes it's part of the strategy, and that's okay. But in order to qualify for Medicaid and get the state assistance for long-term care costs, I think the limit that you can only hold on to is maybe a maximum of $54,000, and that would include your, you know, home value, your IRA account balances, your work account balances, you name it. You know, basically you're on the hook. If you go to apply and you're over that threshold, you're on the hook for paying privately, you know, on your own, And then only once you've gotten through all of your assets, that's when you would qualify for Medicaid. And so, I like to make sure that people are aware of that. And the other side of that is that Medicaid, you're only allowed to pick from some of the it's like basically public service facilities. If there's a nicer spot that you know of or have heard really good things about, or this particular facility that's close to your kids or grandkids that you want to be at, that might not be one that you could use Medicaid to cover the costs for. And so if you want to have a choice in where you may end up, or even having somebody come to your house as opposed to going somewhere to a community or something, that may be something that you consider. So that kind of brings up my next point, is that the type of people that would maybe want to consider long-term care insurance is that you either have assets that you want to protect, or you really do value the type and quality of service that you may receive when the time comes to have this. So if you have significant assets built up and you're confident that you could self-insure, that is a very viable option. However, like I said, if you want to protect any sort of those assets and make sure that a certain portion of them are able to go on to your kids or grandkids or church or community or whoever, having long-term care insurance is a nice way to do that, because it takes a lot of pressure off of your investment accounts in order to pay for some of these costs that we may run into. It happens to be one of the bigger expenses that anybody will incur in their retirement, so I think planning for it accordingly is worth its while. And then, like I said, the other option is that maybe there are assets you want to protect. Maybe that's one thing, but more importantly, you want to make sure that you've got the quality of care that you desire. Maybe it's important that you stay at home the rest of your life, and you never want to be at a community care center. So there's a couple different types of insurance. You can have the traditional long-term care insurance, and that type of insurance, that is it's a good analogy, I guess, is that's kind of like term insurance for long-term care costs. You will pay a premium for the rest of your life. If you don't use it, all those premium dollars you paid, just stay with the insurance company. There's no benefit back. Some of the pros of that type of insurance are that you may get a larger payout option for the long-term care should you need to file a claim. And the other benefit is that there may be a shared care option, where if you're a married couple and you want to have one policy that covers both of you, that may be an option with traditional type long-term care insurance. I guess one downfall is that the premium you pay with traditional long-term care insurance, it usually will increase as you get older. So the amount that you have to pay more than likely will go up the older you get and the longer you pay into it. And it's still even required to pay that premium if you're collecting your benefits. If you filed a claim and you're receiving a reimbursement from them, you may still have to be paying your premium. Another type of insurance is doing some sort of life insurance that has a rider or an included benefit for long-term care. So usually these are in the form of a variable universal life insurance policy, which means that it's a permanent policy, similar to whole life, but there are some differences where you have a life insurance benefit and a death benefit. So if you pass away, your family is going to get some sort of death benefit. However, if you do need long-term care services and you want to pay for that using your available death benefit, there's a rider included with your policy that says you're going to have an accelerated death benefit that allows you to access that value of your death benefit for covering your long-term care expenses. And so it's compared to traditional long-term care insurance, it doesn't have a use it or lose it feature. If you don't use long-term care insurance, there's a death benefit. If you don't need the death benefit, there's long-term care insurance. And maybe you file a claim for long-term care, but you only need that for 6 months before you pass away or get healthy. Whatever's left in your death benefit is still available. And similar, a little bit different, is a hybrid type insurance. So instead of structuring it in a kind of variable form where your principal value is invested, there's another hybrid type insurance where it's a smaller death benefit that would be available, but a larger long-term care insurance that's available, and maybe even a return of premium option, where you can have, if you decide down the road you don't need this policy any longer, you can cancel it and get a large portion of your money back. So that one's called a hybrid insurance policy. And so those are, I bring those up because they're, not everybody knows that those different types of insurance exist. I know that I've met with a lot of people and heard a lot of people say, share war stories about, their parents or grandparents' insurance policy they had for long-term care, and it didn't pay out very well, and it, more often than not, was an older traditional type insurance, long-term care insurance policy. So there are new options available now that weren't maybe 10 or 15 years ago. Oh, excuse me. And then I guess the last thing you could consider is maybe you don't necessarily need long-term care insurance, but you just decide at some point, I want to self-insure. I'll pay the costs, but I do want to make sure that there's at least a guaranteed X amount of dollars that's going to go to my family or whomever. And so you might just consider doing an insurance policy that doesn't necessarily pay for long-term care, but it allows you the freedom to spend your money down as you will, knowing that there's a death benefit from an insurance policy coming later. So that's kind of another strategy you can consider also. So I guess this might be a good time to stop and ask questions. I can and will go over this next little piece, but maybe before I change subjects again, if there's any questions you guys have, I would love to ask. Yeah, I'd love to answer. Oh yeah, and I think
yeah. My name's Greg.
Yeah.
On the IRA distribution, mandatory at 72. Example, if you have $100,000 in there, what's the percent, or how much do you have to take out a year? No one's really ever told me that.
Yeah.
That the government is it a percentage, or is it a dollar amount, or is it, and how long does that go on, or as an example? So let's just use 100,000 as an example at the age of 72.
Sure. Yeah, great question. So there is, the table that I share with clients does have a percentage. The way they calculate it is not necessarily on a percentage basis. It's roughly 4%. So the short answer to your question is roughly 4%, and it does increase as you get older. But the calculation that they use is they take whatever your December 31st account balance was on the year before, and there's this big long table that the IRS has for us, very kind of them, and they have a life expectancy factor, also very kind of them to give us. So you take the December 31st account balance and you divide it by your life expectancy factor, and then that gives you this number that's required to come out of the account. And again, it starts off, I think it's actually roughly 3.8%, and then it increases as you get older. So the idea that, I think the way it's structured is that eventually this money will be depleted. I think they want to avoid having this account that just continues to grow and grow from generation to the next, to the next, to the next. So eventually it will be depleted. And to take that a step further, if you pass away, your kids are still going to be responsible for paying or taking that required minimum distribution based off of your age. So, you'll see that life expectancy factor table go out to like 130, and you're going, there's no way I'm going to make it to 130. Well, that's for your children or who the beneficiaries are, so, yeah. It can be. It's just an amount annually that needs to come out. A lot of times you structure it as a monthly distribution of 1/12 of that value, but you can procrastinate and take it out on December 31st the next year, all at one lump sum too. So, yeah, it doesn't have to come out monthly, but it certainly can.
The second one is on the beneficiary name. You mentioned if you have an account, and let's say, okay, we'll use them 100,000 again.
Yeah.
We'll use my 3 kids.
Sure.
And they're married, but I list my kids' names, not their spouses, as an example.
Yeah.
And one of my children pass away, and then I pass away. But I don't ever change it. Mm-hmm. Does it go to his or her spouse? Or does it only go to the two remaining survivors?
Yeah, no, it would actually go to their estate, I believe, in that situation. So if they've got an estate will established,
right,
those assets would still go to them, but then it would just be further distributed. If it's Washington State where it's joint, exactly, it's joint community property or community property state, then it would still go to their spouse because of the estate, deal. So.
Well, all right, thanks.
Yeah, you bet. Oh, and Yeah, you can also have contingent beneficiaries set up as well. So if something were to happen to the primary beneficiary, you can have a contingent.
Two questions.
Yeah.
With those RMDs, isn't that different when it's a Roth?
Correct. Yeah. Great question. Roth IRAs, they do not require an RMD.
Okay.
So Roth IRAs, you do not have an RMD in your lifetime. When you pass that account on to the next generation or your beneficiaries, they will have an RMD. Again, the idea is that the IRS doesn't want this tax-free growing account to just go from generation to generation to become huge values. There's no taxes still,
Yeah.
but
So,
money
yeah.
does have to come out.
That is an additional benefit of a Roth then.
Absolutely, yeah.
Okay.
So,
What the CARES Act?
yeah.
Yeah. What do you think of that? I mean, the CARES Act is long-term care insurance that's kind of coming through the state, and it's very confusing.
Yeah.
What's your take on that, and how does that affect long-term care insurance?
Yeah, great question. So the CARES Act as a whole, what it provides is $100 a day in insurance for a year. So Washington State has employed this Washington State Long-Term Care Trust Act. There's a trust account now managed by the state that is collecting tax dollars from W-2 employees. Those tax dollars are, funding a trust, and that trust, I'm not exactly sure when the benefits are first available. I can't quite remember those dates. Yeah, it's a few years down the road. They need that money to accumulate, essentially. But it will provide those who are eligible for this insurance from the state to have basically 1 year at $100 a day, $36,500, and it will adjust for inflation. So you asked my opinion. My opinion is that it's not a very big benefit, considering that the average cost for long-term care is closer to $4,000 a month, and that's probably more on the cheap end. I could be understating that. So it's not going to cover quite everything, and again, it only lasts for a year. So it provides some, but not enough, and we can get into the weeds, but the money in the trust can't be invested in anything else besides a fixed income asset, which currently right now with yields being pretty low, it's not going to gain a whole lot. So I think the tax will have to be raised over time, and anyway, that's maybe a different side of the equation.
Looking forward then, even if it does go in, then you're probably going to need some additional long-term care.
Yeah,
Okay.
yeah, I think so.
Okay. Yeah,
I think
that
so.
makes sense. Okay.
Evan, I'm retired now,
Okay.
and
yeah,
I
yeah,
have
yeah.
I have not worked for the last year. I have not accessed any money in my retirement account.
Okay.
If and when I do, what is the tax rate based on? Is it based on my last year's income, which is 0, or is it based on income prior to that?
Yeah, great. So it just shows up as earned income in the tax year that you take it out. So the IRS will view that basically as if you had gotten a paycheck. So it's not based on, the taxes you pay now are not based off whatever you were earning while you were working. You just take a look at your tax bracket situation right now as it is with if you're taking Social Security or if you have a pension or, whatever sources of income you have that may be taxable. And then, wherever you fall in the tax bracket scenario, that's the rate in taxes that you will be responsible for paying.
Well, right now, my tax bracket, my only income is Social Security, so
Sure.
I would be in the lower tax bracket.
Yeah. So you would more than likely be in a lower tax bracket now, maybe than when you were working. And it's, again, it's just, there's your modified adjusted gross income is what they will look at, so your gross income minus your standard deduction, that's your modified adjusted gross income. And if that amount happens to be below, I think for married couples, it's, I forget the exact numbers, but it's a pretty good margin that 12% bracket would probably be the common, in that situation.
So my next question, I already kind of know the answer to, but fortunately, I'm in a position where my house is paid off.
Okay.
So if I need to have some money accessible, maybe to do home improvements or whatnot,
Sure.
I can take out a home equity loan, like say for $50,000, and pay low interest rates on it, which would be better than taking money out of my retirement account, which is in a location where it is still earning money.
Yeah, I mean, that's one strategy, you know, if you're comfortable, you know, with having that loan again against your house, yeah, I think it's a viable strategy. You know, me personally, I don't like debt, so I wouldn't necessarily do that, but yeah, but it certainly is, and I know a lot of people that would rather do that because your house is a secure asset. You know, there's lower risk that your house value would go down as long as you have a means to pay the loan back. You know, with your income.
Well, I have the retirement account that I can always access to pay the loan back
Right.
if I need to, you know, at one point, but
Yeah,
I mean, it just seems like it would be a little bit more of savings on my part to take out the loan like at 3% versus taking out the money and paying the taxes on it and then not having that money there in an earning position.
yeah, you bet. Yeah, and I think there's kind of some personal preference there that comes into play. Another thing to consider might be, you know, what would that payment be that you'd be required to pay on a monthly basis, and what percentage of your income does it represent, you know, at the time? So if you see that, you know, the payment that you're now having is maybe a 25% reduction of your free cash flow, you might decide that it is better from a cash flow standpoint to just maybe use the lump sum versus doing the loan. So it's just something else to consider. But again, I think there's some personal preference there because, you know, loans like that are very reasonable and, you know, I wouldn't say they're non-advisable, but I think it just kind of comes down to how you prefer to, you know, do
Yeah,
things.
okay, thanks.
Yeah.
Anybody else? Good thing my kids aren't here,
Yeah.
as you said, just write them a check.
Yeah.
Money in a Roth IRA is investable.
In
You can invest money in a Roth IRA.
Oh yeah, absolutely. Yeah, great question. So I should clarify. You know, I've had folks come into my office and say, I'd like to buy a Roth IRA. I bring that up as a scenario where it's like, you know, the Roth IRA is not the investment. The Roth IRA is just the account. It's the bucket you're putting your tools in. So, you know, what you invest in the Roth IRA, that's what's growing your investment, or that's what's growing your assets. Exactly, yeah. So you can have, you know, banks offer Roth IRAs. More often than not, most banks, they just allow you to own a CD type product in that particular account. So, you know, if you'd rather be able to invest in a mutual fund or a stock or something else, then, you know, a brokerage account may be considerable. But yeah, the Roth IRA is not the investment. What's in the Roth that you can buy and use as an investment, that's the vehicle.
Okay, what advice would you give me to, if I said I have a significant amount of cash,
Sure.
what I should do with it?
Offshore,
versus-
you said?
Versus, no, just cash sitting in a bank account,
Yeah.
you know? Like if I had $5,000 in an account,
Yeah.
what would be a good place to?
Yeah. So my uncle, you know, I don't know why I feel compelled to share this. My uncle, also, you know, the financial advisor in our family that kind of started it for us. You know, he was at our wedding, and on the little suggestion for the bride and groom, he wrote, "Earn all you can, give all you can, save all you can." That was his recommendation for, you know, for us. And I thought that was so neat. But yeah, I mean, it's you certainly want to give, you know, whatever you can. But I would consider, like, you know, with extra cash that's sitting around, you know, maybe ask yourself, you know, if you have long-term care insurance. If you don't, would putting that money towards a premium on a long-term care insurance plan make sense for you? That might be something to consider. If you have a part-time job, you know, you can contribute cash to IRAs. So if you're doing any part-time work, or if you're, you know, maybe your old job calls you back in once a week or once a month to fill in for somebody, you know, that's earned income. You have to have earned income to be eligible to contribute to a Roth or traditional IRA. So you could contribute, even if your income for the year is only $6,000 or $7,000, you know, if you're over 50, you can contribute $7,000. And you just need to have that earned income reported in order to be eligible to contribute. So, you know, consider that. if you're really, really desperate to do that, go look for a job, go work out at the golf course for a couple hours a week, and, be able to. Yeah, CD. The other thing you could look at is like, something to consider are, tax-free bonds. Tax-free bonds, they pay a little better yield than CDs do, and the income you receive is tax-free. So that's something else to consider, or even just buying, an investment, a stock, or a mutual fund. Exchange-traded funds are also good options too, because if you're worried about taxes, but if this is more long-term money, and you may want that money to be, growing for a beneficiary, you can put that money into an individual stock or an ETF, and you don't have to worry about gains besides the dividends that you may collect. Those are taxable, but as long as you don't sell that particular company or that investment, you won't have to pay any capital gains tax until you pass away, or even maybe not if you pass away. So, yeah, okay, yeah. Okay, yeah. Well, I apologize. I did a kind of overlook. If you have an emergency fund established and there's still extra money, that's where you would start to get creative and look at investing other money. But yeah, I think an emergency fund, having a cash fund available, as little interest as you may be receiving, as much as inflation is maybe impacting it, I think it's really important to have cash on hand. But if there's excess money that's available, yeah, I would look at something else, and even just investing in a joint account. Having a regular brokerage investment account is kind of like having a bank account, but instead of only being able to invest in cash or CDs, you can invest in tax-free bonds or mutual funds or exchange-traded funds or stocks, you name it. So yeah. So yeah, it's if you want specific advice, sit down and chat with somebody and kind of figure out what would be the best thing for you. But if you're just looking for general ideas of what's available, that's what I'm rattling off. Yeah. Sure thing.
Okay. You talked about bringing like tax deferred accounts together into one account.
Yeah.
Because it can be managed by one person.
Yeah.
Which it sounds great. To bring them all together, does that have to be set up in a trust then to be managed by one person?
No, no, not necessarily. So yeah, I'm glad you asked that question. If you have a traditional IRA at a bank that was an IRA CD that you bought 10 years ago, and you have your old 401k account that you rolled over to an IRA, with your financial professional, and and they're the same registration, let's say. And maybe there's even one more. Maybe it's just another IRA account from an old work that you worked at first job out of college or something. If they're all the same registration, so they're all, the same name on each of those accounts, they can all just be consolidated into one. And there's no need for a trust. It's a good analogy, I guess, is like having, a separate storage unit. It's like you've got your stuff at a separate storage unit outside of your house. Doesn't mean you can't bring it out to where you've got other stuff stored. It's just an asset that's tax deferred. It's the same type of registration. It's the same type of tax deferred asset, and it can be transferred and consolidated all into one. So it doesn't require a trust or any extra legwork. It's just somebody like myself. So a financial advisor would do that. Yeah, correct. Or your bank could do it. So if you have an IRA at the bank and you really like having it there, they should be able to do a transfer of pulling those assets to that account. A real life example of kind of how it would work if we've got clients that want to transfer money from another IRA that they have to an IRA with us. We are able to, as long as we have a statement of that account, even if it's a CD and it has just like a CD slip where it talks about the account number, we're able to enter in on our system a transfer document that is basically a request that says, I, so-and-so, Mr. and Mrs. Client, we would like to transfer all of our assets or these particular assets from account number there to account number here at Edward Jones. And, you would sign it and we submit it. Basically, our back office talks to their back office and the assets transfer over, after a period of time. So it doesn't require trust. It doesn't require a whole lot of legwork. It's just, somebody that manages or holds that account for you that can facilitate that transfer. I've often, heard from folks too. I think it's worthwhile to consider that, some people, they prefer or like to have these multiple accounts because they, consider it, some sort of diversification. They don't want to hold all their eggs in one basket, meaning I don't want to have all my money at one particular location. What happens if Edward Jones goes under, or what happens if my financial advisor's company goes under, or whomever? My response to that is, it's, to kind of complete the analogy, it's good to have all of your eggs in it's not good to have all your eggs in one basket, but it is okay to have all of your baskets at one farm. So it's, so I can understand that there's some hesitation with maybe bringing in all these accounts together, but, if I'm sitting across from the table and I'm asking somebody to do that with me and a client of mine, it's, if I'm your financial professional and I'm working with you on your account, I can't give specific advice, one, on this account that's not held under our care, but two, if something goes haywire or something changes in our plan, I have no access or ability to manage that or change that for you. That's something that's there. So that's kind of now your responsibility to work with whomever to make that change. Also, I should point out, if you have Pepsi stock in this account over here and you have Pepsi stock at this account over here, it's two different accounts, but it's the same investment. So your eggs are not in different baskets. If Pepsi goes down 10%, both of those baskets are going down 10%. So, so again, working with a professional that you trust and like, that can help you really figure out how are all of your eggs invested, and are we diversified properly, and things like that. So, yeah, I think that's worthwhile to consider. Yeah.
Thank you so much.
Yeah, you're welcome.
Great stuff. Let's give him a hand.
Okay. Well, thank you. Yeah, I appreciate your time. Thank you very much. I guess the last thing here.
Oh,
I did mention this.
Okay.
It's not something that we necessarily need to go through. If everybody's ready to go and we need to get out of here, that's quite all right. But this is just a nice checklist. So if you are really considering, am I set up okay for my estate? What sort of things should I be considering? When we establish an estate planning goal for a client, this is, Mr. and Mrs. Valued clients, checklist that we would give them. And so it just gives them kind of a list of things to do that they can consider. So do I need to update my power of attorney? Do I need to establish a power of attorney? Have I done, living will, a healthcare directive, things like that. So it's just kind of a nice checklist you can go through on those first couple of pages. And the second and third sections of this are just kind of, if you have a specific goal of, I want to leave X amount of dollars to so-and-so, am I on track to reach that goal, and how does it look? So.
I didn't mean to cut you short there.
No, it's okay. It's one of those things where I thought, this would be nice to have. I think people will maybe value seeing this, but if I'm short on time, I can always add to this, or if it's time to go, we can go too. So.
Okay.
But yeah, I think we've covered a lot. I don't feel overly convicted that I need to go through that word by word. That's something that you guys can read over.
Are there any questions about that?
Yeah, great.
Yeah. That form. Okay, let's give him a hand again.
Okay. Yeah, thank you very much.
All right, and Evan's cards are out there in case you want to follow up, and yeah, thank you.
Yeah, you're welcome.
Great job. So appreciate it. So. Oh.
Yeah, healthcare proxy. I think that's just talking about, again, kind of a healthcare directive, maybe another way to say that. So if you have, some people don't want to be held in, let's say, a vegetative state, and so if you want to say something like do not resuscitate, or there's some specific things that you want to say and have, put in legal documents that, if I'm,
Covered when we have the hospice nurse talk at the last one. And, well, the attorney may cover it too. So.
Exactly, yeah.
Yeah.
So I think that's kind of what it's talking about, and just any specific requests for a situation where you may not be able to have a real clear conversation with somebody about it. You do it now and put it in paper, and
All right.
Yeah, yeah. It's,
Yeah,
That's a
it's a
great deal.
smart idea. Yeah. Good. All right, folks, have a great evening, and yeah, I'm sure if you want to ask Evan other questions, he'll be here for a couple minutes, so, okay. Yeah.